So, what is the result or the lesson we learned from this financial crisis? That is, we should have effective financial regulations, and that we didn't have before this financial crisis. So, let's look at the lesson we learned from this financial crisis. Allow the government taking action to establish the agents, the policies to help to keep the healthy of the financial crisis. So, what are they? So, first, it is the migration, the supervision from micro prudential supervision to the macro. So before the financial crisis, the government thought is if we can keep individual banks healthy and sound, that will guarantee the whole banking system going to be healthy and sound. However, that's not the case. You will notice that because the shadow banking system developed by the commercial banks, so they are working with the security companies, not just among the banks. So that's the reason causing the financial crisis. And so therefore, for the federal government, they are not just supervising the just looking at the smaller picture, each individual banks, they actually look at the whole banking system as a whole to make sure the whole system are safe and sound. And so that is the first change, moving from micro prudential supervision to the macro prudential supervision. So the second is they are passing a law into act in 2010 called the Dodd-Frank Wall Street Reform and Consumer Protection Act. And so the main three items in this act is related to the consumer, the economy as a whole, and how the authority gonna regulating the market. So for the consumer protection, so the Dodd-Frank created a new Consumer Financial Protection Bureau that is funded and housed with the Federal Reserve. Although it is a completely independent agency, and it has the authority to examine and enforce regulations on all businesses with more than 10 billion in assets that are engaged in issuing residential mortgage products, as well as on issuer of the other financial products marketed to low income people. So lesson learned, right? In during the financial crisis, and then the lending agent lend money to the people who have lower credit score, and also people who have low income that actually won't be able to pay the loan back. So in this consumer protection law, and so they are imposed this kind of regulation. So some students might ask why they lend into the low income people, because sometimes people don't have even the high income the consumer as well. So the consumers usually don't have as much information as the lenders. So the lender can just, like I said, they can just talking about it with losing their credibility, but they just try to selling their asset, selling their instruments. And so if they sell to the people who have higher income, that's fine. They can really pay it back. But if they sell to the low income people, after they purchase it, they will realize that they actually won't be able to afford it. So this consumer protection law and require those lenders make sure you guys fine, you want to make profit, but make sure you are ethical. If you know the your people you're lending to won't be able to pay it back, please don't try to marketing and sell your instrument to them. So basically, this is protecting people who are in the low income and also indirectly protecting keeping the healthy of the financial market. So the second component is called annual stress test. So the Dodd-Frank requires that the banks will, with the asset of the more than 10 billion, be subject to every year to stress tests. So a supervisory assessment of the whether banks have sufficient bank capital if they are faced with a scenario of the bad macroeconomic outcome, such as a collapse in housing price or a severe recession. So basically, they want to test those big banks. So if they lend in the money, the asset means like the loan they made it become their the asset. So if they lending too much money, so that means they have a lot of asset. So that's why they have that threshold. So that's a $10 billion. So if they lend it out, they want to see, let's say the financial crisis happen again. Will you guys short in cash? So that's basically they try to test out, because that's what happened. The financial crisis happening in 2007, 2009 is the last step, the banking crisis. So that happened because everybody try to rush to the bank to withdraw the money, since they lend the money out, but the society won't be able to pay the money back. So they actually won't be able to allow people to cash out from the bank account. So that's a bad situation. Therefore, lesson learned. So all those the bank have the large asset, which means they have a lot of loans. They made a lot of loans, so they have to make sure they've passing this stress test. It just in case even people cannot pay the loan back, a certain percentage, larger percentage of people cannot pay the loan back, they still have cash flow. So last important component of the Dodd-Frank is called the resolution authority. So before the new legislation was passed, so the FDIC had the authority to seize the falling banks and wind them down, but it did not have such a resolution authority over the largest financial institutions, those structured as holding companies. So basically, before the FDIC only insured the big banks, but sometimes since the United States doesn't allow to have many big banks, and so the bank cannot branching out. So instead of branching out, so now the big bank actually owning by a lot of companies. So big companies holding share of the banks. So basically, the one big company can control a lot of the banks. So before, like I said, they insure the bank, but they didn't insure the big corporation. We call it uh, holding companies. So actually, after the financial crisis happening, so the FDIC had authority to regulating. FDIC had the authority to seize falling holding holding companies as well. So that is the lesson we learned. And so the last we're gonna talk about is why people trust in the U.S. economy, but why that's a problem. They call it too big to fail, and the future regulations. And so three approaches to solve the big to fail problem have been suggested, because people are thinking the bank is too big to fail. But so we have three future regulation can handle this potential problem. So we're gonna break up the large financial institution, not just bank, but also financial institutions, and increasing higher capital requirements. So make sure they are not just keep lending money out, so they have enough capital in hand, so such as the cash flow, such as the required reserve in the bank. So higher capital requirements in case the financial crisis happen again, and so that they will be able to pay the bank money back. So the last approach is leave it to Dodd-Frank. So we fully rely on this act to fully implement proposal in this act to regulating the banking systems. So that's the end of this chapter.